Okay, let's dive right into this. If you are researching Kansas City real estate investment, you have almost certainly bumped into the exact same three names in every single cash flow conversation. We are talking about Independence, Raytown, and Grandview. Today on The Explainer, we are breaking down these three specific markets, often called the Jackson County Three. But here is the absolutely critical question you have to ask yourself. Are you treating these three markets as exactly the same? A lot of online content just lumps these suburbs together simply as affordable Jackson County. However, that framing completely misses the real differences that determine whether your first Kansas City purchase produces reliable monthly income or turns into a massive, stressful management headache. Honestly, treating them identically can absolutely destroy your portfolio returns. To fix that, here is our roadmap for today. First, we will cover the Jackson County 3. Second, we will compare prices and rents. Third, we will look at tenants and Section 8. Fourth, we will analyze hidden investment risks. And finally, we will determine which market fits you. Section 1. The Jackson County 3, Establishing the Foundation. Let's set the groundwork for this real estate analysis. Just a quick note before we jump into the hard numbers. This is an educational explainer brought to you by Alpine Property Management Kansas City. Alpine has actually been managing properties for investors here since 2013, with over 250 properties currently under management. Please remember this content is strictly educational and is not legal or tax advice.
If you know the area, you know these three cities sit on the Missouri side in Jackson County. This side of the state line typically offers much higher cash flow opportunities compared to the Kansas side, like Johnson County, which usually presents lower cash flow but a totally different appreciation profile. All three of our target markets share identical Jackson County property tax structures, making them the primary entry points for strong rent-to-price ratios.
Section 2. Comparing prices and rents, the hard data. Now, what's really interesting about this is how the numbers frame the financial showdown. Entry price is usually where investor conversations start, right? Looking at Redfin data for early 2026, the median sale prices hover right around the $220,000 to $250,000 mark across the board. But look closely at the target ranges. The actual investor sweet spot for a three-bedroom single-family rental sits way lower than the metro average. In Independence, your target acquisition price is between $170,000 and $220,000. Raytown is slightly lower at $170,000 to $200,000. Grandview has the widest range, spanning $170,000 to $230,000. Now, when we shift to rent-to-price ratios, this is where the cash flow magic actually happens. Across the board, three-bedroom properties generally rent between $1,100 and $1,400 a month. But notice Raytown standing out in the middle. Because Raytown offers slightly lower entry points, it delivers a higher gross rent-to-price ratio, pushing up to 0.8%. Independence and Grandview both sit strong between 0.65 and 0.75%. 5.2%. Keep this number in your head because it is the anchor for our entire financial section. It is the Kansas City Metro average cap rate. The really fantastic news for investors here is that all three of these Jackson County markets consistently outperform this metro average. They offer realistic cap rates ranging from 6% all the way up to 8%, depending on the specific property and your financing. Section 3. Tenants and Section 8. The human element. Spreadsheet projections are great, but tenant pool dynamics dictate if those numbers actually hold up in reality. When we break down the renter demographics, Independence is clearly the heavyweight here. It has the largest and most diverse rental market, with about 40% of its households renting rather than owning. It also boasts the absolute deepest pool of Section 8 voucher holders in the eastern suburbs. For you as a landlord, this means vacancies in Independence tend to fill much faster simply because there are more prospective tenants actively looking. Raytown and Grandview have moderate tenant pools and moderate Section 8 participation, which means your tenant screening discipline becomes even more critical in those two specific markets. Section 4. Analyzing hidden investment risks, or what erodes cash flow. So the crucial point is understanding the variables that secretly eat away at your returns. First up is crime. Based on Neighborhood Scout analysis of FBI data, Independence shows a more moderate crime profile with 29 total incidents per 1,000 residents and a violent crime rate of just 2. When you compare that to Raytown and Grandview, you definitely see higher risks. Raytown has 45 total incidents with 8.5 violent, and Grandview sits at 42 total with 7 violent. Property crime like auto theft and burglary is a higher concern in Raytown and Grandview. That means you need to factor higher insurance premiums and potential turnover directly into your vacancy assumptions. The next hidden risk is maintenance.
This one sneaks up on people. The housing stock in Raytown and Grandview is heavily concentrated in the 1950s through the 1970s. This uniform age means you are often looking at original or once-replaced plumbing, older electrical panels, and aging HVAC systems that are nearing the end of their life. You absolutely must budget an 8 to 12% gross rent reserve for maintenance across all three markets. But be aware that the deferred maintenance burden is significantly heavier in Raytown and Grandview because of this older housing stock.
Section 5. Which market fits you? Let's move to the strategy and see how this builds into our final recommendations based on Alpine's actual property management experience. Alpine's official stance on this is very clear. Independence gives investors the deepest inventory of acquisition targets, the largest tenant pool, and the most moderate crime profile relative to the other two markets. Because of this solid balance of achievable entry prices and manageable risk, independence is the top recommendation for most first-time remote investors targeting steady, reliable cash flow. At the end of the day, you have to match the city to your own investor profile. If you are a first-time remote investor, independence is your go-to market. If you are an experienced cash flow investor willing to accept higher management intensity for slightly better percentage returns, Raytown is a really strong second choice. Finally, Grandview represents the highest risk and highest potential reward option. It requires strict execution and very active management, making it best suited for portfolio diversification by investors who already understand the operational realities of this kind of market. So I will leave you with this final, provocative question to think about. How will you execute your Kansas City cash flow strategy for long-term success? Whether you choose the reliable depth of independence, the higher yield potential of Raytown, or the diversification of Grandview, your foundation must always be professional property management. You need thorough tenant screening, proactive maintenance, and responsive communication to make those spreadsheet numbers a reality out in the real world. For help managing your Kansas City rental property, call Alpine at 816-343-4520 or visit alpinekansascity.com.